the EBITDA in the books is true EBITDA. You buy some other true EBITDA businesses and you end up with another true EBITDA that again fetches higher multiples. And there's a lot of market evidence that that's true. I think where it starts to get murky is if you go even lower, you get into 500,000, 1 million, 1.5 million SDE as opposed to EBITDA. By the time you pay yourself, you add a few managers, you properly invest in this business, your EBITDA actually hasn't grown because your SDE, let's say, is 1.5 million, and your EBITDA now, after all the expenses, is 1.5 million, but you're better resourced. So, and then you do a couple acquisitions, you're still probably in the range of where you bought because you
Sure.
overbought, you overpaid, you paid on the SDE instead of EBITDA. So this is where I think self-funded versus investor funded, it starts to differ because for a self-funded searcher, SDE is true income. Whereas in an
Yeah.
investment-backed business, you got to separate between investor money and your money, right? But yeah, I think the logic is there. The logic is sound. But I think the key here is to really understand the EBITDA versus SDE.
Yeah. That's absolutely critical. What is the, and I think what you were touching on too is that EBITDA is a little bit more baked, right? You've got a platform underpinning the EBITDA, and it's not just a bunch of different companies that are their own operating entities, and any one of them could fluctuate up and down. It's really a holistic unit, and that emphasizes the importance to some degree. Curious your perspective on actually building a platform. So moving all those shared services up top, implementing the software and the back
Yeah.
office stuff up top, and having all the acquired entities leverage that rather than each one having their own